Welcome back, and today let's get into some budgets. To give you an overview of how the budget cycle works, four basic steps, kind of steps that are pretty global, no matter what organization you're in. First off, we're going to develop our budget, and this budget is for the next year. Um, so we're going to develop a budget for next year, and then we are going to submit it for budget approval. And this approval might go to either your boss up in a governmental agency, maybe up to a CEO or a CFO, Chief Financial Officer, but it goes somewhere for a budget approval. Once it's approved, we can implement it. We can execute our budget. So the first couple steps are looking forward. The last couple steps are in the present time period. So we are executing our budget in a present time period. And then towards the end of that budget, we're being maybe audited, or we are going into our accounting practices, and our accountants are rectifying our budget, which was approved. So what did we submit? What was approved? What we do in that year? And then the activities in that year on the accounting side, can we account for all those activities? You might think that budgeting cycle is pretty straightforward, but we have a few different budget timelines that we need to be aware of. Typically, our normal budget, maybe your household budget, maybe track um, your costs and your income in your own home. And you probably run this in a calendar year. What's happening between January 1st and December 31st? So this is for the year of 2018, 2019, 2020, and what's going on in that year. Most organizations that we're going to work with do not follow a calendar year. They either follow a fiscal year or some sort of government year. Probably the most common that you'll run into is that fiscal year. Starts July 1st. So instead of the calendar year starting January 1st, our fiscal year starts July 1st and ends the next June 30th. Your government years typically will start on October 1st and then run through September 30th of the next year. And this is really important when you're talking about the monies that you have to spend. So you were allocated some sort of or some sum of money to spend for your year. Well, we need to know what year we're talking about. Are we talking about calendar year? Are we talking about fiscal year? Are we talking about government year? So for myself, I have some money to spend, but we follow this fiscal year. So my money runs out at the end of June. So I need to know when to make purchases, when to make requests, when to search out for quotes. So we need to be really cognizant and really aware of which year we're operating in. The budget itself, again, not completely straightforward. We think of budgeting as our household budget. We've got money coming in, we've got bills to pay, and it's just an in and out, pretty simple. But when we're thinking of organizational budgets, big agency budgets, now we're thinking in a couple different flavors. There are many different types of budgets, but the two that I really want us to be aware of are our operating budget and our capital budget. Your operating budget is just like your household budget. It's your day to day. You've got money coming in, you've got money coming out, and this is happening in that time period. So our operating budget is year to year. I've got a fiscal year 18, fiscal year 19, fiscal year 20 operating budgets. On looking a little bit more long term with a capital budget, these are our big projects. These are our big purchases that are going to take years to either complete or pay off. So if I am building a new EMS station, that's in my capital budget. That's a big project. That's a big expense. That's a big purchase, and that's going to be reflected in my capital budget, as will vehicle purchases. So things like vehicle purchases and building a new base, a new station. These do not happen day to day. They do not happen year to year. So these aren't yearly things that happen. These are big projects that'll happen once, maybe every 5 years, maybe with stations and bases, maybe once every 10 or 15 years. So these are long-term, big idea, big purchases in your capital budget versus your operating budgets, which is your day-to-day and changes annually. When we talk about budgets, when we are preparing our budgets, we're interested in two things. So we'll boil it down to just these two things: revenues and costs. So money coming in and money going out. And we're going to be a little predictive with these revenues and these costs. So, I'm in fiscal year 19. How do I predict for fiscal year 20? And so on and so forth, fiscal year 21, 21, 22. How do I, because we're building these budgets ahead of time, so we need to know what our costs might be, what our revenues might be, and we're going to use a lot of benchmarking here. You might see this word thrown around. So benchmarking, we're looking at similar organizations. So the organization that you are preparing this budget for, is there an organization that is of similar size, that has similar a client base? So maybe you're working for a county. What's another county that has a similar population? What's another service that has a similar number of employees, runs a similar number of calls? So we're looking at uh, equal organizations and comparing ourselves to them. So with these other organizations that we're going to find, what are their revenues versus ours? What are their costs versus ours? What type of inputs are they paying for? So employees, vehicles, stations, supplies. What type of inputs are we feeding into the organization? And then what type of outcomes are we getting? A pretty common outcome for EMS is response times. So what are their response times looks like? We can argue for or against response times as an outcome or output, but it's there. Maybe ROSC rates. What are our resuscitation rates? What are our cath lab, door to balloon rates, and things like that. So looking at these similar organizations, how do they look like versus what we look like? So let's talk about revenues first. We'll talk about revenues and then costs. But revenues, again, we're being predictive. The first step of that budget process is looking forward or looking into the next year. Um, so it's very predictive. And with our revenues, we are looking for some sort of return on investment. So we're asking somebody for money. No matter how your organization is set up, someone is funding that organization. So we're asking them for money, and what are we going to give them? What are we going to return on that money? So what's our return on investment? We're going to look at a number of things to predict our revenue. One is pricing. What are we charging? Another is our reimbursement rate. What is our collection rate? So we charge one thing, but what are we actually getting? We're going to look at our tax base. Maybe your organization receives revenues based on taxes, local taxes. So we talk about that. Also subsidies. Separate from taxes. Maybe we're getting government money, maybe we're getting public money, even if it isn't directly from a special tax. And then we might be potentially receiving grants. And if your organization isn't receiving grants right now, maybe we should try. And we'll definitely be talking about that in a few weeks with grant writing and how to get some extra revenue, extra income from grants. Now pricing, we'll hit these one by one. Pricing, so this is how much are we charging uh, per per call? How much are we going to send out? Because remember, we can charge whatever we would like. We can bill whatever we'd like. That doesn't mean we're going to receive that full bill. But how much are we charging? This is going to be related to our cost input. So how much does it cost to run a call? How much does it cost to treat that chest pain patient, that respiratory distress patient? We'll talk about this later in subsequent lectures. But how much to charge directly relates to our inputs. Uh, Two sides to this coin. The good news is we are price inelastic. So if we raise our charges, if we raise the cost of an ambulance call to the patient, they're still going to call us. So the demand is really not going to change if we increase prices. But the bad news is our prices are typically very, very public, in the public eye. If we choose to drastically increase or maybe even just slightly increase our charges per call, per patient, per bill, it's probably going to end up in the news somewhere whether it's high profile or not. We're pretty public, and it will be reported. Next is our reimbursement rate. What is our collection rate? So again, we can charge whatever we'd like. That doesn't mean we are going to receive it from insurance payers. So what's our collection rate? Typically look at historical data and what have we gotten in the past. We know Medicare reimbursement rates. We know Medicaid reimbursement rates. Generally, we can predict private insurance rates from historical data or contracts that we might have with our insurers. And then for those who are self-paying, we can look at historical data on self-pay rates. And with this goes into the insurance demographics. So how many of our patients are Medicare, Medicaid, private insurers, self-pays, so we can look back at that historical data and apply it to future possible future trends. So if the proportion of my population is increasing in our Medicare age range, Medicare population, we can predict of those calls how many are going to be Medicare payers. So we can predict some future reimbursement and collection rates. Those contracts with insurers, your organization, if it's smaller, this isn't necessarily going to be applicable. If you're larger, this will be applicable. Larger organizations might have contracts with private insurers, Blue Cross Blue Shield, Aetna, or Cigna, insurers like those, and they might say, well, your patient's copay is $200 for an ambulance ride, but just like our reimbursement rates with Medicare, maybe we can nail down a specific collection rate, a specific payment from the insurer. So for every ambulance transport, the insurer, Cigna, will pay $400 on top of the patient's $200 copay, so we know that we're receiving $600 per private insurer. So if you have a larger organization, you might have some contracts with larger insurers. If you have a smaller organization, probably not as applicable. We also talked about membership programs a little while ago. So you might have revenue and income coming from people enrolling in your membership program. Maybe it's $100 a month or $100 a year. Maybe it's $500 a year, whatever it is. So even if those patients aren't calling calling 911, calling your ambulance, we know that we have revenue coming in through these membership programs. Reimbursement rates, collection rates, not only have to do with your patients paying their outstanding bill or balance billing, but largely upon agreements with your billing company. And, and so there will be some outstanding balance that we send out to your patient. Say you still owe us $200, and your billing company, most of your organizations are probably going to have contracted billing companies that handle this for us. And what we have to define for them is how aggressive we want to be. So again, this goes into the public eye and what is being reported. Just like with raises in charges for each of our patients, the aggressiveness of which we go after our outstanding bills will definitely be in the public eye. So how aggressive are we going to be if our patient doesn't pay his bill within the first few months? Do we send it straight to a collection company? Do we try again for a few more months and write it off? Do we write it off altogether? So what is our strategy on our reimbursement? And what are we telling our billing companies to do? Because if we tell them to be aggressive, they will be aggressive. If we tell them to back off just a little bit because we have a different community view, then they'll back off a little bit. So we have to keep in mind how aggressive we're going to be. Next is our tax base. Your organization may be receiving money from a specific tax. Most commonly, these are property taxes or some portion of the property tax. You might be familiar with the fire-based tax system, fire districts. but your EMS organization either might fall under a fire department which receives these taxes, or may be funded itself. Maybe your third service, county-based, city-based service, and you are receiving money directly from a specific tax. So this is a tax that is specific to EMS, or maybe that fire department that runs EMS. So most commonly, property tax. So we get a portion of that property tax. When we are predicting our revenues, we need to take into account the number of the taxed items. So on property tax, how many properties are there being taxed? Just to begin with, what's the number? And then the value of each taxed item. So I have 1,000 properties that are being taxed in my area, and then what's the value of those properties? And when predicting revenues, we're probably going to take those 1,000 properties and say, what's the average value of those 1,000 properties? And we just take that average value and multiply it by 1,000. That's the value. And then what is the proportion of that tax that we will be receiving? And we can predict our tax revenues. Similar to, but separate from our tax base, might be government subsidies. So this is money coming from our government, whether it's county or city or whatever local government you may have. These subsidies are not from a specific tax. So, your city, your county is going to take in tax revenue, and then they'll take a portion of that total tax revenue across all taxes that it collects, and maybe give you some amount of money. So annually, it'll be some lump sum from your government. Again, that might be the county, might be the city, depending on how you're set up. But your government is giving you some amount of money per year. Now, this may be proportional. They may say we're going to give you $500,000 a year, no matter what, or they may say we're going to give you 20% of your budget. So as you're developing your budget request for the next year, your government is going to give you 20% of that requested amount, or they may give you just a lump sum, let's say $500,000. The last revenue prediction that we want to cover is that of grants. You might be receiving a grant. You might want to reach out and apply for a grant. Money from outside sources, non-governmental sources, non-typical sources that provide revenue for organizations. They'll come in 4 flavors. You might have a foundational grant, might have maybe some sort of local grant, state or national grants. But grants come from all over the place. Your foundations, your private entities. One of the bigger ones in North Carolina is the Reynolds Trust, KP Reynolds Charitable Trust. Last year, they gave out around $23 million in grants. They operate in North Carolina, and it's just a private foundation set up by private donors and other entities. Has a private foundation. These are non-governmental, and we'll talk about these a lot more in our grant writing grants week and lecture. Other grants you might find: local, state, and national governmental grants, public grants. Locally, your public county health departments, local health departments, city health departments might award grants. These would be usually smaller in amount, but they might award grants. On the state level, if you look at OEMS, you look at the State Department of Health and Human Services, they will issue grants on an annual basis, maybe a semi-annual basis. If we look at the national level, one of the bigger grant producing agencies, the Health Resources and Services Administration, HRSA or HRSA. There are a lot of HRSA grants out there that we might be eligible for, and we can apply for on a national level. If you want to get into research, into some deeper issues, the National Institutes of Health, the NIH, provide a number of grants every year for larger projects. So those are our revenues. Now, let's get into our costs. Now, your costs are going to be a larger part of your budget request, your budget proposals. So costs, we're going to get a little bit deeper into costs than we did revenues, because they come in a number of different variations. So first, are our costs indirect or are they direct? So what's the difference between the two? Our direct costs are directly tied to an organizational function, something that we need to have our organization, our EMS agency, continue daily operations. And then our indirect costs, think of those as maintenance costs. So it's not directly attributable or directly applied to running a call, but it's an indirect cost that kind of goes into maintenance. So our direct costs, we think equipment, labor, maybe fuel. We get down into it, IV catheters. So all of these inputs, all of these costs directly relate to providing patient care, directly relate to responding to a call. So I need my equipment, I need my truck, I need my monitor, I need my paramedics, I need my labor, I need fuel to get there, and I need other uh, equipment and supplies to treat that patient, like IV catheters and medications. With my indirect costs, remember these are kind of our maintenance costs. So I want you to think cleaning supplies, pagers for your employees, rent on your stations, rent on your properties, perhaps utilities paid on those properties, your telephone bill, your Wi-Fi, internet bills, and also depreciation of larger items. So these are indirect costs. Cleaning supplies, I don't need that bottle of Windex to to respond to a 911 call for chest pain. Right? So the indirect costs are just kind of the costs of doing business. So we have direct costs, which are directly related to what we are doing, what we're providing, which in our case is emergency medical care. And our indirect costs are just the maintenance costs to support those direct activities. Now we mentioned depreciation, so what do we talk about when we're talking about depreciation? We're typically looking at our larger items, usually vehicles are the largest um, proportion of our depreciation costs, and also any non-expendable equipment, so larger purchases. So easier to think in terms of vehicles are ambulances. We all have, our car that's sitting in our driveway. We paid a certain price for it new, and now it's not worth that new price. It is depreciated. So each year in our budget, we are going to budget in depreciation as a cost. So I have 5 ambulances, and every ambulance is going to depreciate $5,000 per year. So under my costs, in my proposed budget, I am going to enter in $25,000 or $5,000 um, per ambulance in depreciation. All right, now getting deeper into costs, not only can they be direct or indirect, but they can be fixed or variable. So our costs, if they're fixed, uh, the costs don't change as our call volume changes, so or the volume of that service demanded changes. So our fixed costs are going to be there; they're going to be fixed, whether we are running 1,000 calls or 1,500 calls. Our variable costs do change as our volume changes, so as our call volume changes. So if I run 1,000 calls, then next year we increase to 1,500 calls, those costs increase. So I'm going to have some costs in our proposed budget, which are fixed year to year, and somewhere that are variable year to year. To provide some examples, let's think fixed costs. So these costs do not change with we'll say smaller changes in call volume. So if I'm going from, um, let's say I used 1,000 to 1,500 calls before, let's say I'm going from 10,000 calls to 10,500 calls per year. Our fixed costs, rent and utilities of our bases, our stations, our administrative buildings, I'm increasing my cost from 10,000 to 10,500. Probably not going to change uh, the number of buildings that I use. We're not gonna build another base for an extra 500 calls. Salary wise, we're not going to hire new people to cover those extra 500 calls per year. So property, employment, labor, salaries are pretty fixed. I also might have a fixed marketing advertising budget. So maybe we buy a billboard. Maybe we purchase a commercial spot. That's going to stay fixed from year to year. Just because I run an extra 500 calls per year isn't going to mean that I'm buying extra billboard. So all of these are examples of fixed costs. In comparison, our variable costs are costs that do change with changes in our call volume. So changes of demand, changes of in volume, these variable costs are gonna change. So we think IV catheters, fuel. So the more calls we go on, the more supplies we use, more IV catheters we use. The more calls we go on, the more we're driving our vehicles, so the higher the fuel cost. And then we also talk about the piece rate of labor, even though for those extra 500 calls, if we're going from 10,000 to 10,500, we're not necessarily putting a new truck on the road, not necessarily hiring new people to staff that truck, but the piece rate of labor, we might have to pay a little extra overtime. We might have to pay our employees just a little bit extra. We're not hiring anyone new. We're not adding units into the fleet, but we may have to pay a little bit of overtime. So the piece rate of labor, let's say the hourly rate per employee that we have currently might rise just a little bit. Okay, so that's our overview of revenues and costs as we are going to present them in a budget proposal or in our budget. So let's talk about some budget styles. First, we want to go over line item budgets. These are the most common type of budget proposals, budget styles you're going to see. Line item budgets have a line for each revenue and each cost. We break it down revenue by revenue, cost by cost. So we're not grouping things together. We're breaking everything down. So my boss that I send my budget proposal to can clearly see what I think our revenues are going to be and what our costs are going to be. I'll give you an example of a very basic kind of simple line item budget. I've got a few things here for um, for my budget proposal. I've got fiscal year 20, I've got fiscal year 21, so I'm going from one year to the other. I've got a few things, so I'm going to break out employee salaries, vehicle maintenance costs, and office supply costs. So going from one year to the next, I might increase or I might decrease. So I've got the amount I spent, let's say last year, I've got the amount I'm going to spend maybe next year, and then my predicted change between the two. With that, going from one year to the next, I did include a percent change. So let's quickly review on how to calculate that percent change. So it is just very simply the new value, the second value, minus the old value or the first value over that old or first value. And then we can multiply that by 100 to get a percent. So it's the new or predicted minus the old or current over the old or current, and then we can multiply by 100 to get a percent change. So here, those salaries, I'm going from 1,150,000 to 1,250,000. And if I do the new minus the old over the old and then multiply that by 100, I get 8.7%. Vehicle maintenance, there's no change, so there's 0% change. And then office supplies, we predicted a decrease in office supplies. Maybe we needed a couple big items, a couple big printers in 2020. We didn't need them in 2021, so our expenses are going down. So again, the new minus the old over the old gets us a negative 18.8%. So pay attention to those positives, pay attention to those negatives. So if we are calculating our percent change, again, the new minus the old over the old, and if we multiply that by 100, we get our percent change. So we either get 8.7% change, which is the positive change from fiscal year 20 to fiscal year 2021. The next one, our office supplies, we decreased our amount, so we have a negative 18.8% change. So if you want to formulate change from one period to the next, that's your quick and easy formula to do so. You might see that line item budgeting in a number of different budget styles, budget proposal styles. There's incremental budgets or activity-based or zero-based budgets, and there are also performance budgets. Your incremental budget, that's going to be based on last year. So whatever your organization budgeted for, had to spend last year, that's what you're going to build it on. So when I submit my budget proposal, I look at last year and say, what did we spend? And then I predict this year, and maybe there's some proportional increase that I'm predicting. So I can either say there's a 10% increase in my total budget, or maybe I predict a 10% increase in salaries, but a 2% increase in office supplies. All of this will have to defend. So why do you think there will be a 10% increase in salaries? Why do you think there'll be a 3% increase in office supplies? Typically, your incremental budgets kind of enhance inefficiencies. So us in the public sector, we love to budget capture. And the larger our budget, the more kind of bureaucratic power we have. So if we look at last year's budget, what we spent last year, what we needed last year, and increase that by a blanket 10%, it's usually going to create some inefficiencies where there are some activities we're not doing quite so well, so efficient, and maybe we can cut back on those, but that incremental budget doesn't point those out. We just say, based on last year, we need a whatever X percent increase in our budget this next year. If we go back to our line item budget with its incremental budget, I've just kind of switched around the columns here. So let's say fiscal year 20, I've got these expenditures, I've got these costs, and I'm predicting a change for next year. So in my salaries, I'm predicting an 8.7% change. In my office supplies, a negative 18.8% change. Change in maintenance, I'm not predicting any change. So it's just a difference in the frame of things. So I'm still predicting my costs. I'm just basing it on the predictive change in those costs. Moving on from our incremental budget, the most common is our zero-based budget, and as the name kind of tells you, we're building from zero, zero-based. So we're assuming no automatic financing. I'm starting from zero, and irrespective of what happened last year, regardless of what happened 3 years ago in our organization, what do we need this year? So it kind of assumes you're starting from year one, and you're a brand new organization. So what do you need this year? It's probably the most common that you're going to see. We'll use some benchmarking, we'll use some historical data to drive our cost and revenue predictions, but I'm not under, let's say, that incremental budget. I'm not requesting an automatic increase on a certain line item. I'm just saying, what do I think needs to be funded this year? So here's my zero-based budget. I've taken out last year's numbers. All right, you can take out the previous 5 years' numbers. There's no percent change. It's just saying, if we were brand new, if we were starting from zero right here, right now, what do I need? So in this coming year, here are the numbers that I need. and whether or not my boss wants some explanations of those, we can provide explanations for them. But when presenting the budget, when presenting that budget proposal, based on the zero budget or zero based budget, and I'm just presenting what we need in this upcoming year. Another budget you might see somewhat less common, but if your organization contracts with your local city, county area to provide EMS coverage, so maybe you're a nonprofit or for-profit private um, ambulance company, and you are contracting with a local entity, you might be under a performance budget in which your payer, that contract entity, maybe that city or county, is looking at your inputs, looking at your outcomes, your outputs. Largely, these are response times, or maybe sometimes health outcomes. So you're under a contract, and you're paid based on your outcomes, based on your outputs. So your budget hinges on, are you meeting those response times? Are you meeting those health outcomes? Maybe there are for STEMIs, maybe there are door to balloon times. Maybe for stroke, there are certain times that you need to meet. So there are contractual obligations that you're beholden to, and those factor into your budget. One last budget type I'd like to be um, aware of is this activity-based budgeting. Really not common in EMS and healthcare. This is based on revenue and how many inputs do we need to reach our targeted outcomes, outputs, to reach that targeted revenue. So how many inputs, how much cost do we need to reach that targeted revenue? In EMS, we're not really targeting revenue as a primary outcome, so you're really not going to see activity-based budgeting. You may see this if you become part of a for-profit, even a for-profit, excuse me, for-profit organization, whether it's EMS or a hospital or nursing home or any healthcare organization. But once you be aware of it, activity-based budgets are out there, and they are focused on revenue. They're focused on the inputs needed to reach that revenue. So that's our quick overview of budgeting types, budgeting systems, budgeting processes. As always, if you have any questions, comments, concerns, or cuss words, please let us know.